Hey guys, Taylor with GammaEdge here coming at you with a market recap for April 11th, 2025. Yesterday, Bears had a chance to take the market lower, failed to do so. Saw a bit of an intraday rally. A little bit of volatility came out of the market, but keep in mind VIX is still at 37.5. So let's get in our pre-market prep tools that showed us about the intraday rally, then where we may be headed come Monday. So here, our pre-market prep and really our market trending framework, given where we at in the market, always starts with market trend model, which is our way of understanding trend and momentum in the market. It's built off of the tick index, which if you're not sure what that is, you can invest a PDF of it. But effectively what it does is it measures the real-time buying and selling in the market. And then what we do is we take that intraday tick index and we create something called the cumulative tick, which is a time series so we can understand multi-day to multi-week trends. And then not only that, on an intraday basis, we created something called the filter tick, which is a measurement of plus or minus 1,000 tick readings, which is a generally accepted benchmark by the market as significant buying and selling. So coming into the day overall, we could see that the trend was lower. Wednesday, ever so slightly, a little bit of an intraday rally. You can see price here as the neon line. And then Friday, that was sold into. Even the rally attempt that we saw Thursday afternoon, really there was no filter tick buying. Filter tick buying would be up here, and the cumulative tick itself was downtrending all day as well. So this kind of counter trend rally was a bit suspect for that reason. So yeah, coming into Friday, again, really no reason to be bullish here on a kind of a swing trading duration. Anything can happen intraday, right? But in terms of, putting capital to work from a swing trading time frame, like this is just not the environment to do it. There's really no bullish foundational elements that we typically see as a byproduct of our process that are in place right now. Next, what we do is we go look at the SPX options complex and how speculators are positioned. The reason we use the SPX complex is A, it's super liquid and deep, probably the largest observable options market. B, being that it's an options market, it's inherently forward-looking, so we can understand how speculators are positioned going forward. So again, with that understanding and the size of the market, it gives us a really good feel for understanding kind of what the general market sentiment is and how it's positioned. And then coupling that with the market trend model that we just went over, we have a good gauge on where momentum is headed and how folks are positioned out in the future. So here looking at SPX-A, just keep in mind the SPX has two complexes, the AM settled and the PM settled. The AM settled, which we're looking at right here, this is what we call the cruise ship. This is your monthly, your quarterly expirations. This is where kind of the longer term, slower moving money transacts. And what we can see here that the structure is put dominated above and below spot price. So again, no real bullish kind of fundamental signatures that we see when we see a sustained move higher right now. So as part of a market trend framework, we need to see this start to progress and become more bullish. That is, puts leaving the complex, calls entering the complex, particularly out of the money calls. Reason for that is because it's our belief that markets are driven by out of the money call and put speculation. And so naturally, once that out of the money put speculation leaves, we start to get those in the money calls, providing us with a supportive bullish foundation. But next, what we need to see is out of the money calls start to come in above spot price, which again then tells us that speculators are starting to put money to work expecting higher prices. And just so you can see what that looks like, here's a past example of SPX when we were in a call dominated environment. Again, you can just see a ton of green everywhere, above spot price, below spot price. It's quite clear. And then you can also see that we are above the transition zones, which are these white and blue boxes. These are effectively just areas of transition in the structure where we're going from call dominated to put dominated, and they're just not agreement between specific strikes in the complex. Above the transition zones, calls start to be more dominant, and that's where we start to see their influence help to propel price higher. And below the transition zones, that's where it becomes more of a put dominant environment. We start to see that very volatile price action. And again, really right now, there is no transition zone to speak of on the SPX-A complex. And really that's just a function of how predominant the environment is right now with little call speculation. So again, from a swing trading point of view, just going over the market trend model in the SPX-A, you know that conditions aren't good right now. Then here we get into SPX-P. Again, this is your cigarette boat. Reason for that is this is where your daily, your weekly, your 0DT expirations are. These contracts move a lot faster. It's slightly smaller complex than the SPX-A. And these are really where your short-term speculators transact. So this is really where we like to focus because given that we are kind of more shorter-term traders in nature as well, this gives us a really good clue into kind of positioning forward the outlook of the market. Having said that, we were still in a predominant environment. In the money calls were dominating below spot price, but we still had in the money puts dominating above spot price rather than out of the money calls. Again, we want to see those out of the money calls start to come in and dominate this complex for us to, reasonably say that we expect some kind of sustained up move higher. Also within the complex, you can see looking at net open interest, which again is just the difference between calls and puts at a specific strike. You can see there's just a ton of back and forth action between green and red. However, once we get around to the 52, 55, 52, 50 strikes, it really becomes put dominated down from there. So below 52, 55, 52, 50, this is kind of the area where if price was able to get and hold below this level, then we would expect to see kind of a resumption of the down move higher or the down move lower. This should also correspond with the market trend model starting to waterfall lower as well. And then our intraday volume analysis supporting this too, which we will get to in a second. So again, this is kind of a key level for us today, this kind of 52.50, 52.55 zone. And if we're not able to kind of materially push below this level, then just given the nature that it's a Friday and how put dominated the environment is, there could just kind of be a natural propellant higher, a little bit of volatility coming out of the market. Before getting to SPX 0DT structure, just going over a few more of our sentiment indicators as part of our market turning framework. First off is our GEX ratio, which is a calculation of total call gamma relative to total put gamma in the structure. Remember that gamma is inherently more sensitive at the money and closer to expiration. So there's an element of time to this ratio that something like the put call ratio does not have. So as an example, if there's 2 million puts that go out 2 years from now, that's going to really impact the put call ratio. But that's not going to impact the GEX ratio because they're 2 years out from now, don't have a ton of impact on the short-term structure, which as the short-term traders care about most. So all that to say the ratio is, bumping along the bottom. It's below 1, puts are dominant right now. And what we need to see, is to get more confidence is for this ratio start to trend higher, start to, get above 1. And yeah, this would signal to us that call speculators are coming back in the market and or put speculators are leaving the market. But obviously right now, this is not the case. Next thing we have is a proprietary calculation called a true delta and true gamma zero levels. What these effectively do is they are their spot price invariant, meaning that spot price does not impact the calculation. And what they do is they measure the center points between calls and puts in the structure, both on a delta basis and a gamma basis. So we can kind of find that balance point in the structure. What's most important here is to understand the trend of where those structures are headed. So right now we can see that those trends are moving lower, indicating to us that, puts are more dominant than calls right now. So again, we need to see these structures reverse because in an uptrend, these calculations are trending higher over time, not lower like they are now. And then same thing for the SPXP, those same calculations are all trending lower too. So now getting into the 0DT complex, settlement price and, the open of the day was roughly 52.70. The blue blocks is our DEX transition zone. We hit on that earlier in the SPXP. But again, this is just the area in the structure where there is a ton of back and forth between call and put dominated strikes. What we have found is that within this zone, you can think of as the chop zone. Reason for this is because the options moneyness and kind of the market maker hedging requirements really are not impacted within this zone. Reason for that is because of the nature of the back and forth between call and puts, there's little pressure for any one side to act. And just noting just the size of this transition zone, really the past week, this transition zone hasn't even been visible because the structure has been so erratic. And then today you can just see the size of the transition zone, which was 53.05 all the way down to 51.65. So again, that's just kind of indicative that structure is not healthy either. So the first key level was 53.05 that the bulls needed to overtake. If they were able to overtake that, then we would enter something that we call the drunken sailor zone. And effectively what this is even though we are through and we are in a call dominated environment part of the structure here, there is still relatively that advantage is still relatively small. So what we've noticed is that intraday volume dynamics in the actual opening and closing of transactions is going to impact the movement of spot price a lot more than the kind of changing in moneyness of options and those associated flows from market makers, changing of risk. So while we expect, spot price to drift higher above the top of the DEX transition zone, it could be a bumpy ride until we make it through the top of the drunken sailor range. But again, all this to stay like taking a step back, we came into the market, VIX was at 40 to 45. So this just again indicates to us that structure is going to be quite erratic along with spot price. And really following the intraday market trend model and the intraday volume analysis that we'll get into next has been very helpful for keeping us kind of on the right side of those intraday trends. So here is price action for today. So we have this line right here. That's kind of your top of your DEX transition zone. I mean, it corresponded well with prior day high. So I like to see that type of confluence. And then we have the teal box, which is the drunken sailor zone. And so just replaying this session back to you guys, because we were working through this live in the Discord. I thought we had a chance to go lower today. The reason for that is, first off, remember 5250 was the key level from the SPX full complex, which kind of corresponded with the opening print. So that's kind of a good reference point on the day. Second, again, is we were not able to break through the top of the DEX transition zone. So once we kind of failed to progress higher up here, and then we broke through the opening print in 5250, I was thinking, okay, maybe now we start to dump lower a little bit. And then again, in terms of the market trend model, here is Friday's action. So let me get my tool to work. Friday's action right here. What you can see is, we got a little bit of continuation lower, really nothing substantial, nothing like this back here. So that's kind of a warning sign saying, yes, you're getting price action lower, but no, there was really no conviction behind it. And then just, recapping on this tool, then we don't need to come back to it. We just saw a little bit of a buying bid the rest of the session, a little bit of filter tick buying too. So that at least told us that, hey, short was not the play today. Once we started to see this reverse, start to trend higher, that really helped us kind of isolate one side of the market. And then just bringing this back to the chart, again, you can just see the massive chop range that we had today, really focused around the opening print, 5250 level. Then really the trade of the day, in my opinion, was this right here. So what you had here is you had a confluence of prior day high, you had confluence of the top of the DEX transition zone. So that was a great kind of retest of that, and then a move up to the top of the drunken sailor range, which is really where we were pinned the rest of the session. That was probably a 40-point move, I think that was. But nonetheless, just effectively understanding just kind of the choppy market conditions, and then just using those key levels of when that opportunity presents, if it presents, how to take advantage of that. But also to, like understanding if you're a credit seller, as an example, the way you can use this process is, okay, we failed to go lower here. The market trend model is trending higher. We're above, the opening print. We're above that key zone of the SPX full complex. We're starting to get above the top of DEX transition zone. So, selling stuff down here because we're likely not to go there for the rest of the session made a lot of sense. This also brings us to our last tool, and this is our intraday volume analysis. I've teased it a couple times in this video. And effectively what this is what we do is for SPX 0DT volume, on a 5-minute basis, we aggregate call and put volume. We see the distribution, we find the middle of that distribution, then we plot what's called centroids, or the middle point of that distribution. What we do is we plot that every 5 minutes for the call and the put side. We connect the dots so we can form trends. And the point of those trends is to understand at any point in time, say right here, if it's noon, we can understand from the open to noon what the behavior of the call side and the behavior of the put side has been. And then we can infer, all things equal, what the likely price of path is, what the likely path of price is for the remainder of the session, assuming all things equal. And so as an example, this is exactly what it looked like at 12:30, right? The call centroid side was, flat to lower on the session. So again, that line of best fit, we're just projecting that out here. Then the put centroid sign was, flat to higher on the section, which is what we're projecting out here. So what's important to know is that at least the put centroid sign is not rolling over. The call centroid side is not rolling over. However, the call centroid side is not expanding higher as well. So this action kind of puts a cap moving higher. But this action down here with the put side at least puts a cap, telling us that we're not really going to melt down lower either. Because if we were, then we would start to see this action like this that we've seen over the last couple weeks, but we did not see that today. So again, bringing it back to what I was just talking about, being a credit seller, kind of understanding what this signature is. knowing that we're kind of capped where we're going higher and understanding that we're not going lower. Kind of a good environment for selling those spreads. Understanding I know VIX was at 35, 40, so there's still the potential for a ton of price action, but just given what our tools were telling us, we just weren't seeing it. Or again, even if not selling both sides, we at least knew that kind of one side of the market was likely not to manifest, and that was the downside. Just given again the natural move higher, the put side here, the market trend model progressing higher as well, and then we were above all those key levels. So yeah, then just recapping it on this end of day picture again, we can just see the call side was just super flat, really no material move higher. Hence why price just kind of drifted higher as opposed to like, meaningfully trending higher than the put side. Progressed higher throughout the day. And this is just kind of a key signature of what we see, right? Like the signatures can either be both down, converging like this, both higher, or we have a flat side and a trending side. So when we have a flat call side and a trending put side, again, this just tells us likely not to have a collapse lower, but likely not to have a ripper higher. So kind of just a passive move higher throughout the session. So hopefully understanding how to use intraday volume analysis now is clear, how it can be useful on an intraday time basis, pairing that with the market trend model, what that's telling us intraday, and then using those key levels to kind of create a mosaic approach of how you can go about trading intraday price action. And then not only that, but then our market turning framework for the swing traders out there, just understanding when the conditions or what conditions look like when they are better for putting kind of longer term money to work. So with that, you guys have a great weekend. I will see you all next week. Bye.